Welcome to the 90s podcast hosted by yours truly, Kevin Thompson, founder and CEO of 99 Capital Group. Thank you guys for joining us. As I always say, subscribe to the channel. As I always say, go and get my book, MLB2CFP, live on Apple and Amazon. If you have any questions, comments, or concerns, you can email us at info@99capitalgroup.com. Send us your questions. Go to the website at www.99capitalgroup.com. Schedule your appointment. As you know, we're here to do what? Educate, empower, and engage, and also entertain. Follow us on all social media channels at 99cap or at MLB2CFP. Today we're talking about the 5 major tax myths that I want to go through with you. These finfluencers, these social media people out here are giving you guys wrong information, and I'm here today to clear it up. Let's get it. So thank you guys for listening to the 90s podcast. As you know, we're here to educate, empower, engage, and also entertain. And today we're talking about enlightenment because there's a lot of information out there, especially around these finfluencers, these social media people that are giving you information, but not necessarily understanding where that information is coming from. So today we're talking about the 5 tax myths that I want to talk around that have been pandied about on social media. And the first one we're going to start with is starting your own LLC for a tax benefit. This quite literally is the largest tax scheme that people truly don't understand. So let's really dig into this a little bit, because the first issue here is this. I'm sorry about that. People think they could just start a business and write their lifestyle through their LLC as a write-off. Yeah, all of their, well, that's a business expense. That's a business expense. We can do this, cars, homes, all this other stuff. All the stuff that we do in the house is going to be a business expense. We can write it all off against our income. Well, that's fine if you're operating a legitimate at-home remote business. And you have to have income from that business. If you don't have income from that business, the IRS will claw back or disregard any losses you had previously. You have to show that your business is for profit. Because if you're not a for-profit business, it's going to be deemed a hobby. So many people make this mistake because they believe that they can take that income from their W-2 employer and possibly start some kind of deal that has a passive income or something to that effect and write off all of their expenses through that business. Well, I'm here to say you can't do that. It's going to be a giant red flag. So thinking that you can just start an LLC and run your lifestyle through that business is foolhardily. You will be audited because you cannot justify how you're making that business a for-profit business, especially if it's year 1. Hey, maybe you can take a loss. Most businesses do. But in year 2, hey, you know what? It's still a little bit of a struggle. But if it's year 3, year 4, year 5, and you're still not making any money and you're writing off with tons of losses, that's not going to work. And not only will it not work, the IRS is going to say, hey, we're deeming this a hobby and we're going back 3 years. And boom, we're going to make sure that you pay all the taxes that you should have paid. And we are disregarding all of the losses that you took. And by the way, there's penalties, there's interest, there's all these different, and also they can ding you for filing a fraudulent return. You don't want those headaches. So make sure that when you're starting a business, it's a legitimate business and it's not strictly for reducing your taxes. There's another tax myth going around, and it's about the rich don't pay taxes, right? I'm on that side of the fence that, yes, they need to pay a higher share of those dollars, maybe. But they do pay their fair share of taxes. Now, if we're talking about payroll taxes, is it fair that everyone pays the exact same amount in regards to payroll taxes? A millionaire pays up to the 170 some odd $1,000 of payroll taxes, and everybody's capped at that. Who knows? Maybe there needs to be some legislation around that. Maybe there needs to be a hole there put between 176 and 400,000 and starts again. Who knows? But at the end of the day, when people say that the rich don't pay their taxes, that's sort of a misnomer. Now, what I can say is there are ways that the rich benefit from a fair tax scheme, whether it be the way their businesses are structured, bonus depreciation, all those other things from a business perspective, whether it be the deferrals, timing of those deferrals, and capital gains treatment, whether it be 15 to 20 to 20 or the 23.8%. With the NIIT. But one way that's often misunderstood is the way that most rich individuals do reduce their taxation. And that's by having corporate ownership. What I mean by that, if I own stock in a corporation, I can borrow against that stock in my corporation. And when I borrow against that stock in my corporation, I can get whatever the rates are. And it's not your traditional margin rates that we get like 11% or 10%. No, these are very favorable rates that they can possibly run through a bank and get it collateralized. But they use these dollars to fund their lifestyle, and they never pay tax on them. And guess what? Not only do they never pay tax on those dollars to fund their lifestyle, the beneficiary of those stocks moving forward gets a step up in basis, and they don't pay taxes either. So that's a huge benefit for those who are ultra wealthy, who have a huge stock ownership, and who need income but don't want to pay taxes. So if you're talking about the ultra wealthy and the ultra rich not paying taxes, that is one way they do it. But in general, from a W-2 perspective, when they're taking W-2 wages, they typically pay taxes. Now, they may minimize their W-2 ownership, W-2 income. But at the end of the day, majority of them who own those stocks and all those other things are paying taxes. Now, the people that are making W-2 wages that are $1 million, $2 million, $5 million, $10 million, they pay their taxes. They can't avoid it. They pay taxes. But the other people that are CEOs, owners of companies, they can avoid taxation, indubitably. Another myth that's constantly shed on social media or shared on social media is that you can just hire your children. If you're in your business, you can just hire your kids and pay them money and open up a Roth account. Well, you can, and maybe you should, but it has to be a reasonable salary. You can't pay your kid $10,000, $15,000, $20,000 for raking leaves or taking out the trash or doing some kind of work through your office. It doesn't make sense. That is an audit trigger 100% of the time. So make sure when you hire your children, it's not just strictly for beefing up their savings or showing that there's income. It has to be something that's reasonable so they can justify the amount they're being paid. If it's not, you will be audited. So think about it that way. What is a reasonable salary? What is your child doing? If your child is doing X, Y, and Z, the reasonable salary could be X. If they're doing X, Y, and Z on a higher level, it could be Y. Depending on the age of the child, you can't hire a child that's 6 years old that you're going to give them $15,000 a year to do computing work. That's not going to happen. That's not reasonable. So you have to have a reasonable salary, reasonable justification for that salary. And if not, there is an audit trigger. Another one I think is very interesting. You don't have to file your taxes if you make less than the standard deduction. Now, that is typically and traditionally true. But think about it from a standpoint of why you want to file your taxes. you should file. Filing may trigger refunds for over withholding. You may have some earned income credits in there or some refundable credits. Not filing means you could be leaving a lot on the table. You just don't know what you don't know. So I would say always file a tax return. You can file for free online through the IRS website, especially if you don't have a lot of income. It makes sense to file because there's always something in the system. There could be additional tax credits, like I mentioned before, or tax refunds or something refundable amounts that you just may not be seeing. You may be missing and you may be leaving on the table. By the way, there's a 3-year statute to go back. If money is owed to you, you got to go back and file to see if there's any money owed to you. And if you don't do it in a reasonable amount of time, you will not receive that money, and that money will go back into the black hole of the Treasury. And this is another tricky one. There's a 1099 $600 de minimis amount where you don't have to report if you make less than $600 or something like that. So the $600 is just a 1099 reporting threshold. So you must report all income, no matter how small, even if you didn't get a form. I think it's imperative that you file this because, again, you don't want to get caught out. And next thing you know, as an employer, I'm filing these. So if I'm paying someone $500, $400, $500, I'm filing that as a deduction. So therefore, it's going to get reported. And if it's reported in the system and it shows that you have a $400 or $500 income coming in and it's not being reported by you, then there can be some discrepancies there. So what we need to know is always file, regardless if it's the standard deduction, if it's a de minimis amount. If you have questions around filing, it's better to file than not to file. Always remember that. Thank you guys for listening to this 9 Innings podcast about the top 5 social media myths. I know it was a small, quick one, but I've been wanting to get this out there because I think it's important. There's a lot of noise, a lot of misinformation around taxes. People often say that they're doing advanced tax planning. That's just a buzzword in our industry. When you ever hear the word advanced tax planning in our industry, think about what it actually is saying. Advanced tax planning is more of a buzzword to say we're operating in the gray areas. That's all it is. Because tax planning is basically what it is. It's operating within the tax code. And as long as you're operating inside the tax code, there's not really much advanced about it. You're operating within the tax code. I mean, you can do advanced driving. You can be an F1 racer, but you're operating inside the lines. Now, operating in a different manner, going on the edges, around the curves, that's a different story. Thank you guys for listening to the 9 Innings podcast. Subscribe to the channel. Go and get my book, MLB to CFP, live on Apple and Amazon. You have any questions, comments, or concerns, you can email us at info@9icapitalgroup.com. Send us your questions. Go to the website at www.9icapitalgroup.com. Schedule your appointment. As you know, we're here to do what? Educate, power, engage, also entertain. Follow us on all social media channels at 9iCap or at MLB to CFP. Thank you guys for listening. Subscribe to the Substack Now What as well. Stay humble, stay safe, my friends. I'll see you again soon.